Everyday prices across Europe have been rising at an alarming pace, putting severe pressure on our daily household budgets. This broad surge in the cost of living was largely driven by a sharp spike in global energy costs, amplified by ongoing geopolitical tensions. For the average person, this creates a steady erosion of purchasing power. Every week, paychecks cover fewer groceries and basic household necessities. This constant drain on household finances creates a structural threat. If left unchecked, runaway prices have the potential to destabilize the broader European economy. To stop this inflation, the European Central Bank steps in. They operate under a strict institutional mandate: maintain inflation at a steady 2%. To force prices back down, the ECB has deployed its primary tool, launching a series of aggressive interest rate hikes designed to intentionally cool down economic activity. But this medicine has painful side effects. European businesses are suddenly facing intense financing pressure as their borrowing costs skyrocket. Policymakers must walk a tightrope. If they raise rates too high or keep them there too long, they risk severely contracting the economy and triggering a recession. Businesses and consumers alike have been caught in this financial squeeze, waiting for hard data that proves the central bank can finally afford to stop raising rates. Heading into June, economists expected price pressures to ease slightly, forecasting inflation to hit 3%. This chart shows the actual June inflation data for the Eurozone. Instead of stopping at 3%, headline inflation dropped from May's 3.2% all the way down to 2.8%. We also track core inflation. This metric strips out highly volatile categories like food and energy to reveal the true underlying economic trend. That core number also dropped, moving from 2.6% down to 2.4%, proving the headline decline was real. A major driver behind this drop was a steady decline in global oil and energy prices throughout the month. We also saw price growth finally cool off in the services sector, an area of the economy where inflation has historically been very stubborn. Together, these numbers provide clear evidence that the central bank's aggressive rate hikes are finally taking effect across the wider economy. Financial markets reacted instantly. Government bond yields adjusted downward as investors calculated that the immediate threat of more rate hikes had passed. Currency traders drew the same conclusion, stabilizing the euro as the likelihood of further aggressive monetary policy faded. This realization quickly spread across trading desks, bringing sudden calm to environments that had been highly volatile for months. Investors effectively rewrote their near-term forecasts, lifting the pressure off the ECB to force another rate hike at their next meeting. These figures offer the ECB a strategic opening to hit pause, providing the flexibility to monitor incoming data before committing to further action. For businesses, this offers a crucial reprieve from the constant anxiety of rapidly climbing corporate borrowing costs. For consumers, it signals that the rapid drain on their purchasing power is starting to slow down. But the central bank cannot declare victory yet. 2.8% is an improvement, but it remains well above their strict 2% target. This hard-won ceasefire provides the economy with vital room to breathe, while the central bank waits for further confirmation. Officials remain cautious because the data could easily turn. Unpredictable shifts in the labor market or sudden supply chain disruptions are still very real threats. The most significant lingering risk is Europe's energy dependency. If energy markets become volatile again, it could erase the recent progress entirely. An unexpected geopolitical shock could instantly drive prices back up, forcing the ECB to resume raising interest rates. While risks remain, the drop to 2.8% suggests the Eurozone's expansion can continue without the immediate pressure of additional interest rate hikes.